So, this is episode 2 of our financial literacy course. In this episode, we're going to be talking about creating an emergency fund after you've paid off all your debt so that you can survive if there are any emergencies that arise in your life. After you've paid all your debt, what do we do with this money? So, some things that people do when they get out of debt is they get back into debt because now they have money. And that's not the greatest idea because then you're just going to go back to your old ways. One thing you're going to want to do is create an emergency fund. What is an emergency fund? This is like very, very important stuff. You never know when something might happen and you're going to need some money. Or like you never know if you're going to get laid off in work. You never know when, like, let's say you get into an accident and you're not able to recover for it after a certain amount of time. So then they let you go at work, or the disability isn't able to cover all of your expenses. You want an emergency fund for emergencies. People suggest 6 months of expenses. So in this case, 6 months of expenses would be around like $8,000. While we're making this emergency fund, where do we want to save this money? You could, like leave it in your checking account or your savings account and not get really anything out of it. Or you can open up something called a high yield savings account. This is something that a lot of people don't know about, but it's such a strong tool. So a high yield savings account is a savings account with high interest rates. Currently, interest rates as of this time are around like 4 to 5%, 4 to 5% per year. Imagine you make, and this is simple math because in this case, you also get compounding. So you're making money on the money that you're getting interest on. But just to keep it really simple, let's just do 5%. You're making like an extra $400 a year just for leaving your money there. So that's a high yield savings account. That's if you need high liquidity. Liquidity, it means I can use the money or pull the money out when I need it. That's the great thing about having a high yield savings is your money is liquid. You can pull it out. You can use it for whatever you need when you need it. You can also do CDs. CDs is also something that a lot of people would suggest, but in the current market with the high interest rates, it's almost better to be in a high yield savings. High yield savings are usually FDIC insured. So what does that mean? That means if anything happens to that bank or anything happens where you lose your money, the government will give you your money back. So high yield savings are super safe. You leave it there, you make money, you never lose money. CDs are the same thing, but it's not liquid. So CDs are not liquid. The interest rates are usually high during times of interest rates not being super high, but you can't pull it out for a certain amount of time. Those are CDs. I personally don't put money in CDs just because I like to have liquidity. So I like to be able to use my money when I want it. So high yield savings is a high suggestion. So put your emergency fund potentially in a high yield savings. You make your 5% interest and it's compounding. So if we did math on this super simple, divide this by 12, you're making $32 a month just for leaving $8,000 in as high yield savings. This could pay for your gym membership. This could pay for some extra groceries, a movie a month, some Netflix a month, whatever you feel like you want to use this money for, you could use it. Just know though that this will be considered taxable income. And so high yield savings is great. So once you have your emergency fund and you feel like you're comfortable with the amount in there, you feel like if anything happens, you'll be safe, you can start thinking about investing. It's a pretty large topic, so I decided that investing would be its own section as well as all the different options for investing, such as 401k, Roth IRA, and traditional IRA. See you guys in the next one.